It's a beautiful day in this neighborhood, a beautiful day for a neighbor. Won't you be mine? Hey, how's it going, neighbor? Welcome to the channel. I'm Russ. How's it going? Hey, check it out. We're going to go over this beautiful bridge portfolio right here. Everything I bought, what I sold. I actually had some sells. It's true, Dios mio, that I sold some stuff. And again, this is the podcast. Thanks for joining me. If you're watching on YouTube, the next 25 minutes or so, there's going to be no cutting, no editing. We're up on that tightrope live without a wire. We go right to it. We get down to business. And actually, before we get down to business, one thing I noticed today that is really cool, the market is at all-time highs yet again. What's new? It just goes to show you that we look forward as investors, that the market is always looking forward. So we knew that the taper was going to be coming, that the Fed, the FOMC, was eventually going to stop buying assets. They were going to start tapering, as they call it. There was no taper tantrum. I said it. There was no taper tantrum. And instead of buying back their $120 billion a month of assets, which I think is crazy. And actually, I don't know why people are so worried, or they're so worried about tapering. It just means the economy's strong and growing and doing what it's supposed to do, and they're going to take the training wheels off of this economy. Let it go, baby. So yeah, they're going to pare it down by 15 billion. I think 10 billion was going to be less of treasuries bought, and then 5 billion less of the mortgage-backed securities was going to be bought. So hey, that is fantastic. And it means the economy is doing good. Non-farm payrolls were up as well. As I pull up the buys here for the bridge, what do you want to start with? Why don't we start with actually the dividends I received? Again, in this beautiful bridge portfolio that you can check out at degrin.com. The link is in the description below. Whether you're watching on the podcast or on the old YouTube stream here. Well, it's not a stream. The green. So a lot of stuff going on here. I'm green. Got the green light because we're going to Notre Dame on Saturday. Notre Dame versus Navy. My first big college football game. I'm super excited. I'm pumped. Going to be out in South Bend, Indiana, and turn the old, podcast hat around back here, my thinking cap on. And we're going to be going to Notre Dame against Navy, which they beat up on Navy. From the record I look at, it's basically like the Harlem Globetrotters versus the Washington Generals. They hardly ever lose. That's going to be cool. I did go to a game, Northwestern game a few years back when Saquon Barkley, who I'm a big fan of, was at Penn State, and it sucked. It was like a glorified high school game. Terrible. So I'm going to my first true college game, and that's what we'll be doing. So I'll have a video for you guys this weekend. I'm going to record it tomorrow. Hint, it's going to be on the top 10 stocks bought by Congress people. And that should be a fun little video. And I'm going to show you exactly how you can track what these politicians are buying. And one of my favorite places to do that. One last word of advice. I like to give advice here. We're going to get to it in just a second, so hang on. I know some of you love this stuff, but really quick story. My daughter goes to a Catholic school, and she had to do a reading, and she was super nervous about it, that it was going to go awful. But I tried to teach her and tell her that you have to worry about something when that thing happens. Yeah, I'm telling it. Just roll with it. Nobody cares. It's going to help people. Sorry. She can hear me doing the show here, so broke my train of thought. Anyways, what I was saying is that, long story short, is that it went great. It went fantastic. She had no issues. And the point is that I would like to convey to you is to worry about something when the time to worry about it is at hand, not to do it sooner. Because if you worry about something before, you're choosing to make yourself miserable and upset before that thing that might not even happen, and it might not even be as bad as expected. So word to the wise, and let's word to the wise. Why did I do this channel? To help all of you and on your investing journey. And thank you for joining me on mine and making me a part of your investing journey in some small way. So on YouTube here, you can see on the screen that I'm sharing the dividends received for the month of October. Now, I received $27.36 from Kimberly-Clark. They continue to struggle. A lot of inflationary issues. I'm not sure if they're going to have the pricing power. I suspect they will. That's why I always say we have to look for companies with solid balance sheets and have pricing power that they can keep their profit margins the same or increasing. And I know Procter & Gamble can, Starbucks can, McDonald's, companies like that. I think Pepsi can, Pepsi can increase their margins. So look for those companies. That's what's really going to help in inflationary times, is the companies that raise their prices and those people that can pay, and the people that will pay it for those products. Next up, $7.15 from Merck, ticker MRK. Now, Merck, big pharmaceutical company, everybody knows them. I think they're at a good space, and I haven't bought any Merck in a while, just letting those dividends roll in. And now I collect the dividends and then I target reinvest them. I don't like fractional shares, just my preference here. Now we have them in the IRA, of course, but here in this bridge portfolio, I don't want any fractionals. So we cut the dividends with new cash and then target allocate it like a laser, hopefully. Next up, the big mamma jamma money was Big Mo. Ticker MO. Altria paid us $105.30 here in the bridge portfolio. Just Altria is great. I love what they're doing. They're buying back more shares. I think they've ramped it up to $3 billion in share repurchases that they're going to do. And they own 10% stake in Budweiser, so they're exposed to alcohol, cigarettes. They're exposed to cannabis with Kronos Group. So they're just fantastic. And yes, cigarette sales are declining, but hey, it's okay because they keep that money coming in, and they're going to keep growing, and they're going to pivot away from cigarettes, and it's fun to watch these companies do that. Next up, Leggett & Platt, ticker LEG, $10.50. And hint, I did buy more Leggett & Platt. Nobody talks about them. They had a little bit of an earnings miss, so they've pulled back a few bucks a share. And just think mattresses, recliners. They make rods, springs for mattresses and car seats, aerospace system. They're just all over the place. They're the most unsexy new dividend king, by the way. They've been paying an increasing dividend for 50 years. So do yourself a favor and look into Leggett & Platt, ticker LEG. And then lastly, Cisco Systems for the low price of $9.99. We got $9.99 from Cisco, ticker CSCO. So that was a grand total of $160.30 of dividends coming into the portfolio for the month of October. Now, what I did do was we had some sells. I sold IBM. I said I was going to do it. You saw the last couple weeks ago video on IBM, and I'm out. It's just too many financial shenanigans, too much manipulation. The only company that I've seen, and nobody let me know. So if you do know, please let me know what other company has adjusted free cash flow. That's always, but I just can't make an excuse for it anymore. So, man, I dumped my 15 shares from the bridge account. That's why the value went down, and the dividend, the PADI, the projected annual dividend income, also went down because I lost $98.40 of dividend income. But they're spinning off Kyndryl, and I think that they're going to use that as cover to cut the dividend or right size it. So we'll see. Quick number on IBM. They have a PE, when I made this, of 24.63. Now their 5-year average PE, 17.04. So that is 44.5% over the 5-year. And again, their annual yield, the dividend yield, is 5.15% for the 5-year. The average, I screwed up. The 5-year average is 4.48%. And the annual now is 5.15. So that's about 14% over. So they're a little bit high with their PE, and I don't like it. I think that they're going the way of maybe like an AOL or a Blockbuster that didn't innovate fast enough. And I do like, though, that they have exposure to the blockchain and they're trying with Red Hat and the cloud, but I don't know if it's enough. And then I just wanted to right size this. So Merck spun off Organon, which is like women's reproductive medicine and healthcare. They do a lot of things for women. So I had 2 shares of the spinoff. Now, when I did get that spun off, because they had fractionals in that, I received cash, which I think was like $3 or $4 worth of cash I received, which is what's going to happen with Realty Income when they spin off Orion Office REIT. So they're merging with VEREIT, a Realty Income is, and then they're spinning off Orion Office REIT. So you will get 1 share of Orion, ticker ONL. Wanted to say OLN for ONL, 1 share for every 10 Realty Income shares that you have. And if there's any fractionals, you're going to get cash in lieu hitting your account. So I sold my 2 shares of Organon, had an average of $36.95. And that has a PE of 5.67. Now, they don't have a 5-year average because they're a new spinoff. Same thing for the dividend. So they had a dividend yield of 3.03%, but I put that into another pharmaceutical company. So I look at it as I got 1 cycle of the dividends and I sold them to roll into another company, which we'll look at here in a second. So that was paying $2.24 a year in dividend income. So I lost $100.64 in annual dividend income from selling Organon and IBM. So what in the world did I do? What did I buy in the month of October? Pardon me as I pull this up. I closed my freaking window. See, we're live here. I closed my dividend buy window. We're going to have to click it open again, so bear with me while I ponder your life and why are you all whispering up there? Sorry, my family's whispering and I can't find what. Here it is. Okay, are you ready? I'm ready. Back on board. I'm back in the saddle again. So this is what I bought. Do you know what? I don't think I can do that. When I was a kid, I loved trying to do foreigner voices and different accents, but I think that's a thing right now. Let me know. I don't think you're supposed to do. That's cultural appropriation or something now. So you got to forgive me. I grew up in the 1980s and 1990s, and that was just something that was okay. You could mimic people's accents. So we're going to start from the top. This is consolidated because I had quite a few buys, and some days I had 2 buys. Sometimes I would buy 1 share on Monday and then another share on Wednesday. So this is all consolidated and averaged out to save all of us a lot of time. So I bought 5 shares of PepsiCo. I'm buying 1 a week for 100 weeks until I get to 100 so I can start selling covered calls on Pepsi and making them into a wheel, possibly if I get the shares called away. Won't get into that. So I bought 5 shares of Pepsi over the course of the month, averaged at $156.97. Now that PE is at 26.16. So we're paying $26.16 for every $1 of Pepsi's earnings. The 5-year average was 24.97. So it's about 4.77% over the 5-year average, which is not terrible. It's beautiful when you can buy companies that the PE is under, but that one was not. Now, the annual dividend yield on those was 2.74%, with the 5-year average at 2.86%. So again, I love Pepsi, and it's hard because when I started this, it was much better, but it just keeps going up because they're a solid company. And you know what? I'm just buying for the income that they're going to keep generating for years and years to come. So I'm kind of just trying to buy for the income and not so much the capital appreciation. But when strong companies grow their earnings, grow their dividends, people are going to flock to that, and they're always going to view that as a bit of a safe haven, and they're going to put their money into companies like PepsiCo. So hard to get a good discount deal on them. And those 5 shares added $21.50 of dividend income. Next up, we've got one little old lonely share of 3M, ticker MMM. Bought that at $175.25. Now check this out. Their PE is currently at 17.22. The 5-year average, 22.48. So 3M right now is 23% below their 5-year average, which I think is great, and I probably should have bought more, and I might just be buying more with a very nice yield of 3.38%. And also check that out. We got a double greener here. The 5-year average is 2.90%. So currently, that dividend annual yield is 16.55% over the 5-year average. And that added $5.92 of dividend income. Moving along, we're moving along. Number 6, I bought 6 shares of Verizon, ticker VZ. Love my telecoms. I love that they sold off AOL and they sold off their Verizon Media Wing, which also had Yahoo in it. Who knew that AOL was even still around? But Apollo, I think they sold it to Apollo Partners for some few $1 billion. Trying to focus on the telecommunications, the 5G spectrum. They bid $43 billion on that contract from the government, from the satellites that lost it, I think is how it went. The satellites, they bid on it. They weren't allowed, or I don't remember. I'm human. I only got so much space in my head here. So anyway, bought 6 shares, averaged $52.42. Now the 5-year average is PE is 12.26, currently at 9.85, which is 19.66% below the 5-year PE average, which is just fantastic. Now the annual yield, check that out, double greener again, 4.88% for the. I goofed it up again, people. The 5-year average. Let me start that again. The 5-year average is 4.45%, and the annual yield currently is 4.88%, bringing us to about 9.66% above the 5-year average. Wouldn't it be crazy if I did the whole damn thing like that? Just loco. So anyway, those 6 shares of Verizon added $15.36 of dividend income per year. Next up, 3 shares of AT&T. Now, what I love about AT&T that a lot of people don't like is I think it's just a trend that's going on in the telecom space that they also obviously, which I think is going to be fantastic, they are spinning off Warner Media. So they're merging with Discovery and then spinning off Warner and Discovery, which they are a serious competitor to Netflix. I think they are going to spend upwards of $20 billion on new content because new content is king. And I think that's where a company like Disney is going to struggle in the streaming wars, is that their new content is mostly just Marvel and superhero stuff. And you can only watch those old movies so much. So I really love that we're going to get free shares of Warner Discovery, whatever they call it. So I think this is a really long play and a really long hold, and patience will be required with AT&T. Those 3 shares, I got them at an average of $25.35. By the way, that PE, not very good. Currently at 213.92. The 5-year average, 18.4. So PE, just a smidgen over the 5-year average of by 1,062.61%. So again, there's issues, but they're trying to correct it and it's going to take time. But that yield currently, and while it's still going to be paid, 8.21%, the 5-year average, 6.13%. So currently about 33.93% over. That added $6.24 of dividend income to the bridge portfolio. By the way, after AT&T spins off, they're going to right size their dividend, which is essentially a cut. And what that's going to do is that's going to make them not a dividend aristocrat any longer. So there's a lot of aristocrat funds that are going to be forced to sell and dump AT&T. But that's okay because they are still expected to pay a 4 to 5%-ish dividend yield. So just great. The aforementioned Leggett & Platt, I bought 2 shares of Leg at $45.95. PE of 15.37. Now that's about 23% under the 5-year average of 20.12. So that's good. And we got another double greener, dude. The current annual yield 3.66, which is about 5.17% over the 5-year average. And those 2 shares of Leggett & Platt added $3.36 of annual dividend income. Next up, the big one, I love what they're doing, and I think it was a complete overreaction, and I was just so happy to buy up more cheap shares of Altria. They're not going anywhere. They are the giant. Bought 8 shares of Altria at an average of $44.29. That PE currently, though, is 29.66, which is about 36%. Start this over. The current PE is 29.66, which is about 36.49% over their 5-year average of 21. So the PE is over the 5-year, but that yield, I mean, God dang, look at that yield, 8.13%, which is blowing away the 5-year average of 5.85%, currently 38, almost 39% over the 5-year dividend yield average. And those 8 shares added $28.80 of dividend income. But I'll go through these quick. 2 shares of Lockheed Martin at $329.03 average. Now, Lockheed, their current PE, and this is what I love about Lockheed, is at 15.18, and the 5-year average is 22.63. So they are 32% below that 5-year average, and the annual yield is 3.40%, which their 5-year average 2.41%, which is 41% over. So check that out. And this is why I say you can't just always look at price. It's so important that you look at the company as a whole, and they don't have a lot of shares out there, which is why the share price looks expensive, but it's actually not. Check that out again. Just on the PE, Lockheed is almost 33% below their 5-year average for PE, and for dividend yield, they are 41% over the 5-year average. So just a big double green, just a solid company, not going anywhere. The F-35 jet, if you didn't know, makes up 30% of their revenue. So that's both a good and a bad thing because the contract lasts till 2070, but should there be any issues with the defense spending budget, then that could be an issue for Lockheed, and that could hurt their top line. That F-35 if anything happens to that. So those just 2 shares of Lockheed added $22.40 of annual dividend income to the portfolio, and then I got a few more buys here. My old favorite, I don't know what more you can say about J&J. Bought 1 share of J&J at an average of $163.62 with a PE of 24.46, which is below their 73.15 5-year average. And that's so high because in 2018, there was Trump did a repatriation where they could do a one-time onshoring of money, and they had to pay, I don't remember off the top of my head, maybe $8 billion or $14 billion. It was a big number, and that decreased their earnings per share, so that shot their PE up, and that's why, and it was just a one-time thing. So if you look at the chart on their PE history, you'll see that J&J has a big spike up in 2018, and that's why, and then things normalized back down. So, but I think their average is around 22 if you factor that one-time expense out. So it's a little bit over, but companies like that are so solid. I really don't mind paying up for J&J. The annual yield currently 2.59, which the 5-year average, oddly enough, is 2.59, right on the button. And J&J has been increasing their dividend for 59 years, so they're about to have 6 decades of increases, and that added $4.24 of dividend income to the portfolio. And then, of course, you heard in my video, I said I was going to do it. I did it. I started my position in Apple. I think it's a little bit expensive, as we'll see here in a second, but they're so strong, so big, and I'm hoping we get a market correction and pullback so I can just really ramp up the Apple. But I'm probably just going to leave that one share there, and it's a mental trick that I do, that I leave that one share out there, and I have an average. So the average is 146.96. So now whenever Apple drops below that $146.96, I'm going to be able to say, okay, I'm below my average, so it's going to make me want to buy and bring that average down. So it's so much easier, of course, to average down than it is up, but I'm getting that out of my system with Pepsi because it seems like all I've been doing is averaging up with that. So back to Apple. The current PE is 26.21. The 5-year average is 22.13. So it's about 18.44% over the 5-year average. So it's a little bit expensive, paying up for that quality. The annual yield is only 0.60%, but the 5-year average is 1.62. So that yield is really low, and it's what turns me off. And they're so that's almost 63% below the 5-year average. So it's tough. It added 88 cents of dividend income. I'm not going to go heavy into it. I just wanted to get my foot in the door, so to speak, with Apple. And again, I'm hoping we can get down to maybe the 120s, 130s, and I'll really pick up more there. But I got it. I got the one share, so we'll just, I've got many years to go here, so we'll just add and build up from there. And last but not least, one share of Gilead, ticker GILD, and that average was at $64.80. I bought that share. They have a PE of 11.09, which their 5-year average is 76.44. So that is 85% below the 5-year average. And a lot of these biopharmaceuticals, we see this, they shoot up. They have phase 3 trial happening. If you don't know, phase 3 trial is when they start testing on humans, and that's the last and the hardest phase to pass. So when they have drugs in the pipeline moving into phase 3 trials, then people get excited, they buy, they think they're going to cure the next big thing, and they shoot up, and then people realize they bought too much too quick and got ahead of themselves before things were finalized. So Gilead is another biopharmaceutical company that I really like. That current yield is 4.38%, which is really nice, and their 5-year average is 3.39. So the current dividend yield is about 29% over the 5-year average, and that added $2.84 of dividend income to my little old bridge portfolio here. So for the month of October, that added $111.54. So yeah, we lost a bunch with IBM, and I'm up a little bit. I still have some cash left to spend. And tell me what you added, what you're planning on adding. I really would love to hear it. And if you're curious about Pepsi, I did a video a while back about the 50 shares that I bought and what that looked like, where I bought those at. And I'll do another video here in, I think I have 73 shares, and I'm probably going to buy 73. I don't know. Whatever it is, I'm close to 73, 72, 74, something like that. So let me know what you think. Get in touch with you. Again, I'm on Twitter when I can. Really busy. But check this video out about Pepsi right here, and I will talk to you there.